Well, I think we might start now. And firstly, I'd like to say welcome to everybody who has joined this Taxation Law Research Program, TLRP, webinar, and also people who are coming in and joining as I speak. We're very pleased today to have Professor Choi Xiaojing speaking to us from Wuhan University in the mainland. And I noted, speaking earlier with Professor Choi, she's a pioneer because this is the first time, the first of many, I hope, but the first time we've had a tax expert speaking to us directly online from the mainland. And it's really, it's great that she's been able to join us. Professor Choi is a professor and PhD supervisor at Wuhan University School of Law and deputy director of the university's Institute of International Law and director of the Wuhan University International Tax Law Research Centre. I should say Wuhan University is really very well known for producing a remarkable number of excellent students specialised in tax law, PRC tax law, of course, but also international tax law. We have one visiting with us at Hong Kong U at the moment, and a previous student from Wuhan University was a postdoctoral fellow with us, Professor Xu Yan, who's now at the University of New South Wales. Professor Choi has done postdoctoral research in both France and in the US, where she was sponsored under the Fulbright program, which is great recognition. And she's done a great deal of work in the area of international tax law. She's worked on, presided over 10 significant research projects, including a major project of the National Social Science Foundation of China and certain other important projects, and provided advanced commentary and analysis for the Ministry of Finance and the State Administration of Taxation, for example. She's also published widely, both in China and internationally. So we're very lucky to have her speaking with us today. The topic of today's webinar is global minimum tax reform in China. So the presentation will focus on the G20 OECD Pillar 2 international tax reform, discussing its possible impact on China and what China might do in response. You can see the details about the proposals from the BEPS proposals, as they're called in short, from the G20 OECD about the two-pillar tax reform package. They're set out in the flyer, but they are very important. And as Professor Choi notes, they represent one of the most important, if not the most important, multilateral attempt to change international tax law in the last 100 years. And of course, they're very important in terms of how China sees them and how China interacts with them. My knowledge is limited, but my understanding is China has been generally very supportive of these developments and changes as it clearly understands how integrated it is with the world economy and how beneficial that's been to China. But these developments, this sort of integration brings with it all kinds of interesting tax questions. That's enough from me. Professor Choi, over to you, and we're all looking forward to hearing your commentary. And I believe there'll be some time left at the end for some questions and answers. So feel free to put your questions up on the Q&A system of Zoom. And I should just note that the lecture is being recorded. It will be available on the TLRP website, as will the PowerPoints which are being used. Professor Choi, welcome. Welcome to Hong Kong.
Thank you.
Thank you.
Thank you, Professor Richard Cullen and Professor Wilson Xu. Hello, everyone. I'm Choi Xiaojing from Wuhan University Law School, and I'm honored to be invited here to share with you the latest development of G20 and OECD Pillar 2 reform. The topic of my speech today is global minimum tax reform and China. In the presentation, I will focus on the main rules of global minimum tax and analyze how China should respond to this global tax reform on its international interest and development needs. Okay, I hide my picture and hide myself and ask a student, the audience, to focus on my focus on my speech. Okay. For a long time, before presenting the specific rules, let's look at the background of this tax reform. For a long time, some jurisdictions have attracted a large amount of foreign investment by lowering corporate income tax rate and granting preferential tax treatment, which has triggered the problem of race to the bottom. According to the United Nations estimates, every year countries lose $500 billion to $6 billion in tax revenue due to the profit shifting by the multinational enterprises. In order to solve this problem, OECD and the G20 are vigorously promoting global minimum tax reform worldwide. On October 8, 2021, 136 jurisdictions have reached a consensus on the two-pillar solution. Following this historic agreement, the OECD Secretariat issued Global Anti-Base Erosion Model Rules, Pillar 2, on December 10, 2021. Altogether, this document arguably marked the maturity of the design of the Pillar 2 proposal as one of the two-pillar solution, or the design of global minimum tax reform. The global minimum tax reform aims at ensuring that large multinational enterprises pay a minimum level of tax on income generated by their operations in each jurisdiction. It's about to establish a broad, coordinated minimum tax regime worldwide and includes global anti-base erosion rules, global rules for short, and subject to tax rule, STTR for short, respectively. Next, I will briefly introduce these rules. First, the global rules apply to multinational enterprises groups with an annual revenue of more than 750 million euros. It consists of the income inclusion rule, IIR for short, and annual tax payment rules, UTPR for short. The IIR is the major rule, while the UTPR is intended to serve as a backstop to IIR. The global rules take a top-down approach, which means a UP jurisdiction will have priority to levy the top-up tax, and if it's fair to do so, the intermediate parent entities jurisdictions down the ownership chain will be entitled to top up the tax. Even if the low tax income is not subject to any top-up tax and the IIR, other jurisdictions may still deny the deduction or make equivalent adjustment and UTPR. Literally, the global rules have an option nature. The October statement stipulates RF members have the right to decide whether they will implement global rules, and when they don't adopt the rules themselves, they still have to accept the application of the global rules applied by other RF members. It seems that countries still enjoy flexibility in their policy decision. However, in my opinion, the interlocking structure of Pillar 2 will in fact substantially affect the country's policy decision. That is to say, when UP jurisdiction does not implement IIR, the MNES may still be subject to top-up tax of other jurisdictions, which causes that the tax which had belonged to UP jurisdiction flows out into the treasury of other countries. On the other hand, if the low tax jurisdiction does not raise its ETR to 15%, its taxation revenue will be flowed out into other countries, which apply the global rules. In order to prevent significant loss of national interest, both resident and source countries will be motivated to introduce the minimum tax. In the recent discussion of the global rules, in addition to the two rules mentioned above, another important rule focused worldwide is qualified domestic minimum top-up tax, QDMTT, which has been included in the design of the model rules. The QDMTT is essential, a minimum tax that is included in the domestic law of a jurisdiction. With it, the jurisdiction will be entitled to impose a minimum tax on its domestic constituent entities when their effective tax rates are below 15%. QDMTT actually changes the original top-down approach of the Pillar 2. It allows the low tax jurisdiction to connect the top-up tax before other jurisdictions apply the global rules, thus preserving its own taxing right. Second, with respect to STTR, it's a tax treaty rule serving the interest of developing countries. Pillar 2 provides that a source country, as a developing country, is entitled to request the inclusion of the STTR in a bilateral tax treaty if the sum of the notional and corporate income tax rate applied by the resident country to interest, royalties, and a range of other clearly defined expense is less than 9%. In the order of application, the STTR takes precedent over the global rules. And in order to avoid double taxation, the tax paid under the STTR should be treated as covered tax and global rules. The OECD is still working on the model rules of STTR, which may be released later this year. Now, I'm going to analyze China's stance in this reform. On October 13, 2021, Chinese Finance Minister Liu Kun attended the G20 finance ministers and central bank governors meeting, stating that China has consistently supported and worked to promote multilateral consensus solutions to effectively address the tax challenges arising from the digitalization of the economy, and will continue to play an active role in the framework of the G20 and OECD in the next step. Meng Yuying, Director General of the Department of International Taxation of the State Administration of Taxation, said in an interview that in respect to Pillar 2, China advocates that the design of the tax system and the determination of tax rate belong to the tax sovereignty of a country and should be decided by each country independently. The global rules and Pillar 2 of the consensus proposal should not be implemented as a minimum standard, but a common approach for jurisdictions that wish to implement them in a harmonized manner. China advocates that while curbing harmful tax competition, the development needs of economies at different stages of development should be fully considered. China also advocates that the global minimum tax is a means rather than an aid to combat BEPS, and should avoid adversely affecting substantial activities, and should support the globalization of enterprises and create a beneficial environment for them. China's two-way FDI in 2021 is greatly active. Accounting for larger volume globally, China's outbound FDI outflows ranked in the top 3 globally for the 10th consecutive year, and the FDI inflows ranked second in the world. China is now accelerating the construction of the new development paradigm featuring dual circulation. in which domestic and overseas markets reinforce each other, with the domestic market as the mainstay. First of all, it's built on the basis of a unified national market, not around a small cycle of self-engagement. Secondly, it's an open domestic and international double cycle, not a closed domestic cycle. Building a new development paradigm, on the one hand, requires that China is committed to creating an excellent business environment, encouraging scientific research and development and technological innovation, and giving full play to the integrated effort of policies to enhance economic resilience, and on the other hand, pursue the free flow of cross-border capital factors to improve international competition. In this context, with China's deepening participation in global governance, just like Professor Richard said, China wants to be integrated to the world market. The reform of the international tax system will have an increasingly far-reaching impact on China. Next, I would like to share with you how the above rules will affect China's tax system and the global trend of carrying out the minimum tax reform, and how China should respond to it. First, the global rules will challenge the tax-bearing credit provisions in China's bilateral treaties. In order to promote the implementation of the Belt and Road Initiative and encourage more enterprises to invest overseas, China has signed many tax treaties with many countries, which include the tax-bearing credit provisions, which grant a notional tax credit for the tax not paid and special incentive schemes or similar allowances in the source country. It assumes that the tax has been paid in the source country, although the tax was actually waived for reason of economic policy. Tax sparing is a concession to ensure that the foreign tax incentives granted to attract foreign investment capital for particular activities are not recaptured by the residence country. In the Belt and Road context, the residence country usually is China. With the sparing credit provisions, China outbound enterprises can effectively enjoy the tax incentives of source countries. Currently, there are 6 BII jurisdictions that unilaterally grant tax sparing to China, and 29 jurisdictions include tax sparing clauses in their tax treaties with China, such as Vietnam, Malaysia, and Cambodia. Take Vietnam as an example. In recent years, China has been maintaining close cooperation with Vietnam. In 2020, industry-wide direct investment of Chinese enterprises in Vietnam reached $1.38 billion, and a new engineering contract in Vietnam reached $4.95 billion, reflecting a growing trend. Vietnam is taking much effort in attracting foreign investments, and it has stimulated in their domestic law that enterprises investing in projects in coastal and port economic zones apply a 10% income tax rate for 15 years, with the first 4 years exempted and the next 9 years reduced by half. And in 2016, Vietnam lowered its corporate income tax rate from 22 to 20%. In other words, those Chinese enterprises investing in Vietnam's preferred project will be granted a 4-year tax holiday, and will also be able to pay corporate income tax at 5% for 9 years, and enjoying a 50% reduction in corporate income tax after the 15th year. For earlier and easier understanding, we regard the statutory income tax rate as effective tax rate, in spite of a slight imprecision as a result of the tax-bearing provision in China and Vietnam's bilateral tax treaty. These enterprises repatriating profit to China are regarded to have paid 20% tax in Vietnam. Hence, they only need to pay 5% of their profit to the Chinese tax authorities. Therefore, their global tax burden will be respectively 5%, 10%, and 15% in different years. But what if China implemented the IIR? Once China implements the IIR, these enterprises can no longer be deemed to have paid a tax in the source country and credited against the tax of China. Currently, the income tax rate in China is 25%, so they are required to repay more in taxes to the Chinese tax authorities on their Vietnamese income, which makes their total tax burden at least 15%. In other words, before China implemented IIR, these enterprises only need to pay 5% of their Vietnamese income in back taxes to China in the foremost 4 years, where after that, they need to pay 15%. Therefore, the implementation of the IIR in China will lead to an increase in tax burdens of Chinese enterprises investing in Vietnam and hinder the development of the Belt and Road. And it is also caused the problem of treaty override. To solve this problem, suggested that the tax deemed to have been paid according to the tax-bearing provisions should also be treated as the covered tax in the ETR calculation of Pillar 2. Second, the global rules is now consistent with China's participation exemption system. The slide shows that the dividends exclusion provision of global rules. From them, we can say that the eligible dividends received by constituent will be excluded from the global rule tax base, and the two conditions must be met for the eligibility. Firstly, the shareholding percentage exceeds 10%. Secondly, the consecutive shareholding periods exceeds 1 year or 12 months. If both of these two conditions are met, then the dividends will be excluded from the global tax base. This is basically consistent with the participation exemption regime, which is quite common in developing countries. But excluding dividends from the global tax base, it can avoid potential conflicts with the participation exemption regime. In recent years, China is also introducing the participation exemption rules in numerous areas, such as Hainan Free Trade Port and Hengqin Corporation Zone. Dividends from subsidiaries established with new development in the tourism, modern service, and high-tech industry sectors will be exempted from corporate income tax if the following conditions are met. First, the shareholder holds more than 20% of the shares of the foreign subsidiaries. And the second, the statutory corporate income tax rate of the investment destination jurisdiction is not less than 5%. Basically, the Chinese participation exemption system remains consistent with global rules. But there are still some differences in the details, such as a subject minimum shareholding ratio, consecutive holding periods of shares, etc. As shown in the table of the slides. The left one is the regulation about China's exemption participation rules, and the right one is about global rules. This inconsistency between China's participation exemption rules and global rules will negatively affect the development of Chinese outbound enterprises and is not conducive to their competitiveness overseas and impacts the implementation of China's Belt and Road Initiative. The superficial differences of legislation here could actually put Chinese enterprises at the risk of Pillar 2 due to underestimation of the effective tax rate of China. In response to the aforementioned problems, China could make the following institutional optimization. To be consistent with the global rules, China may expand the scope of the participation exemption rules of Hainan and Hengqin in Guangdong, Hong Kong, Macau, Great Bay Area, make it no longer limited to the 2 types of enterprises, but all types. Meanwhile, China could reduce the minimum tax shareholding ratio to 10%, set a 15% threshold for the corporate income tax rate of investment destination jurisdictions, and require a consecutive shareholding period of not less than 12 months. Third, the global rules are incompatible with Chinese CFC rule. Chinese CFC rule is in some way similar to IIR of the global rules. They are both used to impose tax on the low taxed income from foreign subsidiaries. But the application of both of the 2 tax rules may result in double taxation. To address this issue, AIIFL members negotiated a consensus on a trade tax distribution rule, but it has a maximum allocation quota for tax on CFC passive income, which will lead to some inconsistency between the global rules and the Chinese CFC rule. I share the specific rule in the slide. From it, we can say that the tax on CFC passive income allocated by China to the jurisdiction where the CFC is located may not exceed either the CFC tax collected in China, nor the amount of top-up tax on that passive income in the CFC located jurisdiction. Therefore, the conflict arises when Chinese tax authority applies both IIR and CFC rule. First, Chinese CFC rules does not distinguish the type CFC income and levy tax on all the income. When applying global rules in the future, the Chinese tax authorities will need to identify the CFC passive income before making full or quarter allocation to other jurisdictions. This will directly increase the cost of collection and administration of tax authorities, reduce its efficiency, and bring about risks in enforcement. Second, China usually applies the statutory corporate income tax rate of 25% on the CFC deemed distributed dividends, which will result in CFC tax not being fully allocated to the jurisdiction where the CFC is located. After jurisdiction, expect allocated CFC tax to cover tax. If the effective tax rate is still below 15%, the CFC income, counterparty of the unallocated CFC tax, will be taxed twice. In addition, there are differences between the Chinese CFC rules and the IIR. In terms of applicable subject, the tax base and tax rate, the slide could be your reference if you have an interest in this. In particular, both of them have an exclusion rules on tax paying, and their logic is similar. That is, if the effective tax burden in the CFC located jurisdiction and the effective tax rate in a jurisdiction where the multinational enterprise group operates reach the minimum standard respectively, the taxpayer exempted from applying regime, CFC regime, and the IIR However, there are inconsistencies in the criteria and the threshold for tax exclusion between the two regions. I have presented the differences in this slide. I think China can take efforts to solve the above problems in the following three aspects. First, revise the CFC rule and stimulate that only CFC passive income is taxed. This move will help tax authorities now to take make additional identification of passive income when implementing the tax distribution rule of globally, but can improve the tax law enforcement efficiency. In addition, at present, most countries only tax passive income, so this amendment will also facilitate the internationalization of China's tax rules. Secondly, tax the CFC passive income at 15% of the corporate income tax rate. This measure will avoid double taxation of taxpayers due to the quota allocation rules of GloBE, reduce the tax burden of taxpayers, and create a favorable tax environment for Chinese enterprise to go global. For example, the Netherlands has proposed in its tax reform document to apply a 15% tax rate to CFC income in order to eliminate the inconsistency among domestic regions. Finally, raise the minimum effective tax rate of CFC's tax paying exclusion provision to 15%, and draw global rules to identify the effective tax burden of the CFC located jurisdiction. This step will ensure a uniform tax test between the Chinese CFC rule and the global rules, help reduce the compliance cost of taxpayers and the enforcement cost of tax authorities, and realize the mutual convergence between domestic and international tax laws. Fourth, global rules will pose a challenge for China's tax incentive policies. Since the unification of the corporate income tax law for domestic and foreign enterprises in 2008, China has been applying a statutory corporate income tax rate of 25%. Although it is much higher than the global minimum corporate income tax rate of 15%, does not mean that the effective tax rate for all constituent entities in China can reach 15%. And the basic background of tax cuts and fee reductions, as well as the global coronavirus epidemic, China has introduced a large number of tax relief policies and extended several tax incentives for special industries, sectors, and regions, as shown in the table of the slides. If applying the above-mentioned single or multiple tax incentives, Chinese constituent entities could have the effective tax rate lower than 15%. In the case, if other jurisdictions have the prior right to impose top-up tax according to global rules, the tax benefit enjoyed by the Chinese constituent entities will be offset by the top-up tax levied by other countries. China's tax incentive policy will be nullified, and tax revenue foregone by China due to policy reasons will be captured by other countries. In the fact of this challenge, some countries or regions are currently planning to taking the following three measures to deal with it for keeping their business attractions and global rules. First, using non-tax preferences as alternatives. Singapore has indicated that tax competition may be reduced with the implementation of the Pillar 2, but other forms of competition will increase. Singapore may pay more attention at the competition rather than in the tax field. This approach helps build a fair, healthy, and sustainable international tax environment in the long run, but it may reduce taxpayers' economic benefits in the short term, resulting in lower acceptance by enterprises. Second, choose other fiscal policies. According to Swiss Federal Council, in order to maintain the attractiveness of business investment, the additional tax revenue raised by implementation of Pillar 2 will eventually provide space for the fiscal policies of the cantons. Swiss cantons can provide sufficient support for local enterprises by changing the items of preferential tax or granting financial subsidies. This method will neither increase or decrease the national tax revenue, nor reduce the tax benefits that taxpayer can enjoy, but it may cause unfair tax treatment among different sectors and industries, and anti-subsidy investigation by other countries. Third method that is change the way of the incentives. The UK has adopted a tax policy of R&D expense credit for large enterprises groups, which constitute the qualified refundable tax credit, QRTC, and Pillar 2. Compared to the policy of additional tax reduction for R&D cost, this rule helps reduce the risk of top-up tax for taxpayers and ensures that the company can receive tax support. For China, it's suggested making the following efforts. First, adhere to the basic position that domestic tax should be fully imposed. Ensure that domestic constituent entities are taxed so that their effective tax rate reaches 15%, preventing domestic tax outflows to other countries. On the taxation level, China can simplify and integrate the current tax incentives, which will help reduce taxpayers' tax compliance cost. Take high-tech enterprises as an example. At present, they can enjoy a preferential tax rate of 15% and also apply the policy of additional tax reduction for R&D cost. Although these policies can provide tax relief, it also poses a compliance burden for them because they need to complete high-tech qualification and R&D cost identification and aggregation of beforehand. China could consider canceling the current tax incentives and directly apply an enterprise income tax rate higher than 15% but lower than 25%, such as 18% or 20%, which can improve the tax efficiency and also avoid Pillar 2 risks. Alternatively, China can also introduce QDMTT and impose minimum tax on domestic constituent entities. Second, China can reasonably adjust the tax incentive to fully provide support to taxpayers. For example, China can learn from experience of the UK and establish a tax credit for R&D expenses to avoid the tax incentives enjoyed by enterprises being offset by the global rules. Finally, global rules may also have an impact on the VIE structure. In order to raise capital for their overseas listing, some Chinese large enterprises, such as Alibaba, usually set up VIE structures. This slide shows the equity structure chart of Alibaba. This kind of company has incorporated a listed company in a jurisdiction such as Cayman, but its effective management may be in China. In this case, it's the resident country of the multinational group UPE in Cayman or in China. This issue will determine who has the prior right to levy top-up tax. The 2020 Blueprint report proposed that this issue should be dealt with through the tiebreaker rule in the tax treaty. However, in the absence of tax treaty between the two countries, or if the two countries cannot reach a consensus after mutual consultation using the treaty tiebreaker rule, how to deal with it is a still unresolved issue. In my opinion, such multinational enterprises should pay particular attention to this issue in the future, raise their awareness of tax risks, communicate with tax authority as soon as possible, and reduce tax uncertainty. I suggest that China introduces an advanced ruling to provide taxpayers with platform for application and communication to improve the certainty of tax laws and create a better business environment. In the future, we can continue to use MAP to resolve the dual resident conflict and also use advanced ruling as a try. The essence of taxation is to meet the public needs of our society. Taxation is the main form and the source of income for the national public finance, and will directly affect the amount of financial revenue and further determines the quantity and the quality of public goods and the services that a country can supply as well as the welfare of its citizens. However, this does not mean that in order to meet the public needs of society, all countries are obligated to pattern after one standard to expand tax sources and raise tax rates. When formulating international tax policies, it must be taken into account that different countries are at different stages of economic development and have their own interests in mind, and their international tax policies must be made in a differentiated manner for catering to different public needs of each country. Rulemakers need to take into account the fiscal and tax policies of countries at different stages of their respective development, whether they are developing country or developed country. Meanwhile, it should also be considered that reservation should be allowed in the multilateral tax conventions to be signed in the future. In this way, the balance between the different policy objectives should be achieved. That is, preventing tax-based erosion and increasing fiscal revenue in developing country and promoting sustainable economic development through tax policies in developing country. Okay, that's all my sharing. Thanks again to Professor Richard Cullen and Professor Wilson Xu for inviting me here. Welcome you to visit Wuhan University, one of the most beautiful campuses in China after the epidemic. Thanks for the audience for listening. And this is a code. This is a QR code of our team, and our team's WeChat public platform, where we continue to follow up the two-pillar global tax reform and share the latest research results. We appreciate your attention and welcome your communication, and sincerely wish that Wuhan University Tax Law Research Center could exchange and cooperate with the TLRP program of Wuhan of University of Hong Kong on a larger scale in the future. Okay, ask me if you have any questions. I found the question on screen. I'm worried that we are the reviews.
I think, yeah, there are two questions there.
Okay, there are two questions. The first one is, do you have any other suggestion for Chinese legislation on global rules in the future? Okay, I try to answer the question, okay? I'd like to talk about the effective date of global rules. OECD stated in October that IR and UTPR will be respectively implemented in 2023 and 2024. But as it stands now, the effective date has been delayed, with the UK and Hong Kong both suggesting the implementation of the global rules should be delayed due to competitiveness issues. In sense, determine when the global rules will take effect in a game between countries. That is, an earlier effective date means that a country could capture tax revenue earlier, but would sacrifice their enterprise's competitiveness, while later effective date could ensure the competitiveness yet at the expense of tax interest. That's so when should China take into account into the global rules? I think a sensible date is when the global rules is implemented globally. This will help China to keep a balance between safeguarding national interest and protecting the competitiveness of enterprises. At present, the global implementation of global rules has been delayed, and the future is uncertain. And there is no consensus within the EU on the Pillar 2 directive. In order to meet the challenges, China should stay cautious and calm in this international tax reform, making itself well prepared for the implementation of Pillar 2. And including working on the legislation and the revision of relevant tax regulations. Meanwhile, enterprises should declare their income lawfully and global rule, which depends on the quality, cultivation of international financial and tax participation and connectors in China. This my answer for the first question. Okay. The second one is about CFC rule. Let me say, thank you, Professor Trey. I'm wondering that we're the revision of the Chinese CFC rule, which only taxes passive income, cause an increase in the cost of connection and the administration by the Chinese tax authority. Okay. No, I don't think so, because each country needs to identify the passive and positive income of CFCs in the process of implementing the global rules and their current regulations. Different country has their own different regulation on the definition of a CFC, passive income. For example, some countries could be regarded the dividend interest and royalty could be passive income, CFC income. But for the other countries, the rent income and the lease income and the insurance income could also be regarded as passive income. So different countries have their own definition on CFC passive income. In the future, Chinese reform of only taxing passive income can look at the implementation of the global rules. It can avoid a high legislative cost to a certain extent for larger MES, identifying passive and positive income by applying the global allocation tax rules will also reduce the cost of connection and administration for tax authorities. At present, in the world, most countries only tax passive income of a CFC, and such a measure will also help our system to be in line with the international rules. Moreover, the global tax base is a balance of the substance carve-out excludes from the global income, which is essentially a tax on passive income. This move will help to further harmonize and align our CFC system with the Pillar 2 rules. Okay, that's the second answer for the second question. The third question is about what will be impact of the inconsistency between the Chinese CFC rule and the global rules on China. Okay. Okay. Okay, let me try to answer your question. I think it's how to say, the question is a little complicated because I want to cite an example for you, okay, to explain my answer, okay. The inconsistency between the Chinese CFC rule and the global rules may lead to double taxation, as the global rules provide for tax distribution rule, but there's a maximum distributive limit on CFC passive income taxation, which will lead to double taxation. For example, let's say a controlled foreign company located in Cayman earns all passive income of 10 million in the year and then pays zero corporate income tax in Cayman. The Chinese residents owns 100% of it. At this point, the amount of dividend deemed to be distributed to China by the controlled foreign company located in Cayman should be 10 million according to the Chinese tax law. And the tax can be levied by the Chinese tax authorities in this regard is 2.5 million. Therefore, the covered tax allocated to China in relation to CFC's passive income is 2.5 million. Meanwhile, the percentage of CFC top-up in Cayman is 15%. 15 multiplied by passive income of 10 million equals 1.5 million. According to the maximum CFC location income of 10 million equals 1.5 million. According to the maximum CFC tax allocation limits, the CFC located by China to Cayman will be the lesser of 2.5 million or 1.5 million, which means that the covered tax that China should allocate to Cayman is 1.5 billion, and the 1 million tax levied by China cannot be allocated to Cayman. However, after Cayman adds back 1.5 million to be covered to the covered tax, if the effective tax rate is still below 15%, this will mean that passive income of Cayman CFC will be subject to another top-up tax, which gives rise to the problem of double taxation. Okay, the calculation is a little difficult for me to explain. If next time we have the chance to communicate offline, perhaps I will calculate on the screen correctly, clearly. Okay, thank you. Okay, I think the other questions, the other questions. Will you share your slides with the audience after this webinar? Okay, I'll discuss later with Professor Richard Cullen, okay? This problem about sharing my slides, okay? The final question is about, given there has been recent debate regarding whether the Pillar 2 rules conflict with provisions of the tax treaties on the international tax stage, has the state administration indicated any instance in regard of this issue? Okay. I'm so sorry about that question because I'm not an official from state administration of taxation in China, so I cannot answer this question to you. But I think perhaps in the future, if the tax treaty conflict with the Pillar 2 rules, I think the decision maker will find a good solution to resolve this conflict. And if they can't resolve this problem correctly or perfectly and in respect of Pillar 2 rules, I think in China, for state administration of China, China's Chinese tax authority could try to avoid the conflict between the two two documents. perhaps we will have a try to modify our treaty or modify our domestic law. But I don't know the question, the conflict in detail. So next time, if we have free time, we can discuss after this discussion online. Okay. Thank you, Professor Richard Cullen. Okay.
Well, thank you, Professor Choi, and thank you for looking after all of the questions so well. In fact, we're almost at the end of the time. I must say, I knew it was complex, the operation of the global minimum tax, but I didn't realise how complex. So I'm still digesting the material. I haven't kept up to date as much as I should have. But you've really given us a great deal to think about. And just following up on that question, after you've had a look at and reviewed your slides, let us know if you're able to provide them, and then we can put them up online on the TLRP website. But you can come back to us and confirm about that. Is that okay?
In fact, these days I try to write an English article about Pillar 2. If I have the chance to publish my article in English journal, I think the audience can see my article in publication. Okay.
Well, that would be good. That would be very good as well. And you can keep us alerted about that. And we can also, once the article is being published, we can circulate that information. But I see the time has almost come to an end, and I think we've dealt with all of the questions. So I'd just like to say thank you again. It's been a great pleasure having you with us, and great to have this experience of getting somebody speaking to us directly online from the mainland. I'm sure there's going to be more opportunities to do this, and indeed a need to do this, because the sort of difficulties you've talked about, and there are many other aspects to international tax, and then people are also concerned about how the system is being changed and reformed in Hong Kong. And I don't want to be talking about things I don't know much about, but I can see clearly that the greater integration, commercial integration coming with the Greater Bay Area is going to lead to much more intense discussion about cross-border taxation between Hong Kong and the mainland in a way that we haven't seen before. So once again, thank you. Best wishes with all your excellent research. Keep sending your fine students to us to visit us in Hong Kong. We're pleased to have them visit. And I can say it's not very Chinese, but it is Australian. I can say Happy Christmas and Happy New Year as well. Thank you.
Okay, thank you.